So now let's take a look at how day traders make money. And two very important things you need to learn about is something called going long, as you can see here, long, and going short. So let's begin here by taking a look at what going long and going short is. So first of all, what is going long? Well, going long is the most common way for day traders to make money. And this is basically when you buy low and sell high. So let's just say that this right here is a stock chart. It goes up like this. When you go long, you basically want to buy low. So let's say that you buy right here. And then you want to catch a short-term move and sell high. So let's say that you bought down here for 100. Let's say that this right here was $100. And maybe you sold here at $110. So you sold up here for 110, then you would make $10 here. Or to be honest, you would actually make a little bit less because when you trade, you will have to pay a small fee, but maybe you would make, let's say $9 or $9.50. So going long is pretty straightforward, but the opposite of going long is going short. And what is going short? Well, to go short or to simply short, as I said, is the opposite of going long. And this is when you make money from the price going down. So once again, let's say that we have a stock chart right here. And in this case, we have a market where the price goes down. This is what we call a bear market. But what you do when you go short, I will not go into detail here, but what you do is you do something called short selling. And this is actually when you sell a stock without owning the stock. You basically borrow crypto or stocks, you sell it right away, and then you wait for the price going down, and then you do something called buy back. And let's say that this stock went from 110 to down to 100 here, then you would once again make $10. So this right here is one thing that is so nice about day trading. You can make money when the price goes up, but you can also make money when the price goes down. And another important thing I want to talk about is something called leverage. And what is leverage? Well, day traders can increase both the reward but also the risk by using something called leverage. And in very simple terms, leverage is a tool that multiplies both the gains and losses. So remember the example where we gained $10. If we use leverage, let's say that we use a 2x leverage. That means that for every dollar we win, we now win $2 instead. And for every dollar we lose, we now lose $2 instead. So if we use a 2x leverage, this $10 will be $20 instead. And of course, we can use even higher leverage. So if we, for example, use a 10x leverage, we would have made $100 and so on and so on. And later on in this video, when I talk about day trading platforms, we will talk about, how much leverage you can use when you trade and so on and so on. But one thing I want to point out right away is that, in general, if you are a beginner, using leverage is very risky because yes, the reward goes up, but also the losses goes up as well. So make sure to have that in mind. And this is why I have the last point right here. To make money on a consistent basis, it's important to have good risk management. So you can't just go into day trading and use, 10x leverage and think everything's gonna go to the moon. That is a recipe for disaster. You need to be able to manage your risk. Alright, so this video was actually just a very short clip from our full day trading course here on YouTube. To watch the full course, simply click or tap on the screen right here. I hope I will see you all over there very, very soon.